Um, okay, welcome everyone. I hope you're all suitably caffeinated. Um, we've got a lot to cover here, the entire global macro outlook in half an hour, so we'll try and keep it tight. Um, just some quick introductions. I'm Will Cager-Smith. I'm the US editor at 9fin, which most of you probably haven't heard of. Um, we're a technology-driven news and analytics service covering corporate credit. Started in Europe, but we're now expanding into the US. So I'll let the panelists introduce themselves. Conrad, do you want to go first?
I'm Conrad DeQuadros. I'm an economist at Breen Capital.
I'm Gary Zero. I run AB's fixed income insurance business. I'm also the lead PM for our multi-sector insurance mandate.
I'm Silvio Tavares. I'm the president and CEO of VantageScore. We're one of the two national credit scoring companies. We serve about 9 out of the top 10 banks and about 3,000 banks across the U.S. And we really are focused on predictive power and financial inclusion.
Hi, I'm Jonathan Miller. I'm that guy on the left of what they used to have up there. I am a senior U.S. economist at Barclays. I mostly cover Fed and the macro outlook for the U.S.
Okay. So first of all, do we want to can we get the first polling question up? Which is around the Fed funds rate. I think if we're talking about macro, we kind of have to start with monetary policy. So the Fed has been pretty clear that its objective is to break the back of inflation, and that it's going to continue hiking rates until that happens, until it achieves that. So one of the potential outcomes from that obviously is some kind of recession. So I want to start by asking, and maybe I'll go with you, Jonathan, for this one. Do you believe a recession is now inevitable, and what do you think it might look like in terms of length and severity?
Well, we certainly have as our baseline a recession. We think that the odds have become higher and higher as we've gone through time and as inflation has become more and more persistent and as the Fed has become more and more hawkish. So in our eyes, it's very hard, given what the Fed has laid out for itself in terms of reaction function, for them to avoid a recession. Right now, we're writing down a recession that lasts for 3 quarters. It's a pretty mild one. We only have output going down by about a 3/4%. We do have the unemployment rate going up to 4.9% next year. So by historical terms, a pretty shallow one, but I think there are definitely risks that it could be more severe if the Fed does end up over tightening, or if we see more persistent inflationary pressures that force them to tighten more.
And one of the major things that's driving inflation is the strength of the labor market. And speaking in fairly simple terms, I mean, it seems unlikely that the Fed is going to achieve its objective of bringing inflation down without some people, potentially a lot of people, losing their jobs. So if we're talking about a recession, what do you think that means for the labor market? How bad do things get there? Conrad, do you want to kick off that one?
Well, actually, first thing I'll push back on the notion that this is predominantly labor market driven on inflation. I think we have a persistent and broad-based inflation problem, and I think it has a lot to do with inappropriately accommodative policy a year ago. So unfortunately, the good options for the Fed are no longer there. I think the Fed, unfortunately, is boxed in here and has to continue to raise rates. But if we look at how persistent inflation has been, we have we look at things like how many components of the CPI are rising more than X%, and one of the things that we've seen there is more than a 5% annualized rate. We have more than 50% of the components of the CPI rising at more than 5% annualized rate. So I think it's really driven by the stance of monetary policy. Obviously, the labor market is part of the story, but it's not the entire story. So I think persistent inflation, broad-based inflation, and I think one of the things that's being perhaps missed in all of this, with the focus on the Fed funds rate, is I think one of the drivers of inflation is the balance sheet, and we've had a significant increase in the Fed's balance sheet. It's a very different type of QE this time than last time. It's QE that in part has resulted in very large cash balances by households, and I think that's an important driver of the inflation.
Does anyone else want to hop in with some views?
Yeah, I'll jump in and I'll be the contrarian. I think it's always slightly boring when everybody agrees on the panel. So I'm going to disagree. I think the reality is the consumer is very healthy. If you look at the average credit scores, we see all the credit scores across the United States. The average credit score for a consumer right now is 697. That's about 13 points higher than prior to the pandemic. It's about 2 points higher than a year ago. So the consumer is really, really healthy. If you look at overall spending, if you look at consumer credit balances, they're up about 14% on a year-over-year basis. And if you look at the banks that are underwriting consumers, they're not tightening down. You continue to see very robust account opening. So that all points to a very solid economy and very solid consumer. And I think banks are also very healthy and have good balance sheets. The question is, will that last over the next year? I think there's a reasonable probability that it will. The Fed is going to have to pump the brakes hard. We're at an ABS conference, so I'll do a little joke. They're going to have to hit the brakes so hard that the ABS on the wheels kicks in. But the reality is the economy is well and the consumers are doing well. That's what our data shows us, and we're a very data-driven company. I don't think there's no risk of a recession. Of course there is. But the reality is right now we're doing pretty well.
So let me add a little bit of nuance to what's been said so far. So I think I would downplay the balance sheet really as a big driver of the inflation that we've seen over the last year and a half or so. I think this started out as a supply chain phenomenon that basically we had a lot of goods being demanded during the economy and during the pandemic, and that really caused all sorts of supply chain problems. And we saw all sorts of bottleneck issues over the course of the last year or so. Those seem to be unwinding right now, and we're seeing lots of evidence of that in goods prices. But what's happening now is that we're seeing a very persistent labor market, and that goods inflation has morphed into service inflation. And that, for us, puts the emphasis squarely on the labor market. So the Fed really needs to slow the labor market in order to slow wage pressures going forward. So that basically is going to be one of their key objectives going forward. They're going to need to see meaningful declines in job openings. They're going to need to see payroll numbers slow. And it remains to be seen just how much they have to hike rates to make that happen.
Gary, we haven't heard from you yet. Do you want to jump in?
Yeah, I'd love to. I think from a market perspective, like what's been discussed right here on the panel is exactly what is going on in the market, right? Like I'm a market participant. The way that I'm thinking about this is that like the price action that we saw in the credit market, I would argue is that it's exactly what the panelists has been talking about, is the fact that the range of outcome has now expanded meaningfully as we head into 2022. We have no idea to know for sure. If we have a crystal ball, we will, but we don't. That's the reason we have no idea to, at least at this point, to feel comfortable or feel confidence that who is just going to be right. So for that reason, I think that's the market is pricing in a much wider range of outcome instead of pricing in an actual downside from that perspective. So if the Fed is going to be data dependent, I would argue that market participants in their term is going to be data dependent as well, as they're digesting new information as it comes on a monthly basis or a quarterly basis, whatever the frequency that they get the information to we assess risk in this market. So the theme that I use this year, 2022, is forecast often. That's the reason that we thought the smart guy smarter than I am, to trying to figure out what the heck is going on in the economy.
Yeah, it's interesting, isn't it? I think with COVID, the impact of that was not necessarily easier to model, but it was a bit more binary. There were kind of like clear chains of cause and effect that you could sort of trace, whereas now it's kind of all bets are off, much wider range of outcomes, like you were saying. So I want to talk about housing briefly. I'm personally interested in this as someone who's been on the sidelines of the housing market and waiting to, find my moment to become a homeowner, and just being kind of pushed back at every turn. So affordability has obviously been a big issue for a while. And now with rates so much higher, the overall cost of housing has put home ownership out of even more out of reach for many people like me. So what impact does that have on the market, and how do you think that changes over the next few months? I mean, Silvio, do you want to jump in here?
Well, yeah, I mean, I think it's clear that if you look across all credit products in ABS and RMBS, and you look at credit cards, there's an increase there. Activity has continued.
I think we have a slide on this actually, right?
Yes, yes.
Sir?
And Well, I'll just keep talking until we get there. I covered this, but if you look at credit card balances, you look at personal loans, you look at auto loans. Every one of those categories continues to grow through the end of September. The only exception is mortgage, where the rise in interest rates has had actually a really significant impact on new originations. I do think there is a challenge with how our very vibrant RMBS markets work, in that 80% of mortgages in the U.S. are conforming mortgages. But there is some dysfunction because there's not competition in the credit scoring of those mortgages, and so that result is that, like, you have 4.8% of the total mortgage amounts that are guaranteed by Fannie Mae and Freddie Mac going to African Americans, when African Americans represent 12 to 15% of the population. 4.8% only they get, and that's a result of a lack of competition in credit scoring. And so the FHFA is looking at that. They're going to promote a new rule which will allow credit scoring companies like VantageScore to compete against FICO. That's going to open up access, and so I think that's going to be a key driver of growth in the credit markets, because access continues to be a big challenge. But I think overall the environment, yes, it's slowed, but the reality is that those asset prices of residential homes are going to continue to go up, and so the credit quality is not going to change materially. That's what investors in this room care about. We're going to see that quality remain, but there's just going to be lower activity, with the exception of granting African Americans, Asian Americans, Latino Americans greater access to that market, and that's going to be the next driver of that market going forward.
Okay. So staying on the consumer side of things, Gary, I wanted to ask you, from a kind of portfolio management perspective, when you think about structured products, consumer related structured products like credit card ABS, cell phone ABS, RMBS, that kind of thing, how do you think those various markets perform given all the kind of macro pressures that we're talking about?
I think the expectations, and we all know here, is that things are going to get worse before it gets better. I think it's really the question of magnitude, and how does that magnitude of increase in delinquency, which then translate into losses, compared to the credit enhancement that we have on the bonds. And if I take a step back and kind of think about how I've been thinking about this, right? I guess before I even go there, so just a quick disclaimer, right? So at AllianceBernstein, we run many POC of our portfolios. So I guess my comments on the portfolio action that I'm describing is only related to the part that I'm responsible for. So the way that I think about it is very simple, right? If I have to believe in a CFO or treasurer, no offense to anyone who's a CFO treasurer here, but if I have to believe on someone's willingness and ableness to deliver the company or to manage a company through the next credit downturn, I'd much rather to believe in the structural protection that we have in the ABS market. So bond that is well structured with built-in credit enhancement, as well as the leveraging mechanism that is built in, that we get delivered. A good example is it's the auto space, right? So prime auto, whatever the case you want to call it, with the excess spread that you have built in, and also the structural deleveraging that you have. The bond deleverages over time. Again, if I have to believe in the structure versus a human being, I much rather believe in the structure.
Okay, so that kind of tees us up nicely to go from consumer credit to corporate credit. So there's a large cohort at this conference, I suppose, that is focused on the CLO market and therefore the outlook for leveraged loans. So in the leveraged loan market, there's this kind of double-edged sword at the moment, in that higher base rates mean better returns, but at the same time, that impacts free cash flow, and the general state of the economy is raising the prospect of higher defaults. So Gary, is someone who invests not just in CLO tranches, but in a bunch of other corporate credit products like leveraged loans and high yield. Where do you see value and risk in this kind of situation as we go into that kind of potentially quite wide range of outcomes that you were talking about earlier?
Yeah, so thinking about fundamental versus the actual valuations, right? I don't think valuation has really taken into the consideration of I think the valuation has taken into consideration a wider range of outcome, but probably hasn't really taken into the consideration that things can get a lot worse before it can get better. The way that we think about how to position the portfolio this year is really what we call defensive carry, but stay invested. The reason really it's the fact that we don't know, again, which way it's going to go. But you want to position your carry position that is defensive and high up in rating quality as you weather through the storm. Now, taking a step back and looking at corporate fundamentals, the corporate balance sheets this time around, I think some of the panelists has alluded to that this time around, at least we're entering into a business cycle with much, much better corporate balance sheets in terms of net leverage, right, including cash, or corporation has really termed out their financing needs over the next 2 years. So the thing that we're watching for is more the macro levels in terms of like how long this recession potentially would be, and also how deep. I think that really depends. That would really determine 2 years down the road when all those leverage loans or high yield bonds or IG credit bonds that matter that we get to refinance in a much higher rates environment. How well are they going to be able to insulate from a credit perspective?
Does anyone else want to jump in there in terms of corporate credit and the outlook? Conrad, maybe.
Well, yeah, I'll try to frame it in terms of the macro backdrop, and and go back to where we started from, talking about recession, and I too think that recession is inevitable. I don't think it's imminent. And related to corporate credit and credit in general, one of the things that I think is important, and this also relates to QE, is the fact that I made the point about consumer cash balances still being very high. And I have a chart, and it might be the previous one, which is showing looking at the Fed's data on household holdings of cash, checks, checkable deposits, savings deposits, money market mutual fund shares. And what I'm doing here is I'm looking at sort of the middle part of the income distribution. And if we were to continue to grow these cash balances or liquid assets at the rate that we were seeing, growth rate that we're seeing pre-COVID, compared to where we are now, there's about $1.2 trillion more than that prior growth rate. That's just what we view as sort of excess liquid balances for the household sector. That is a very important factor for the near-term outlook. I think it's therefore an important area of support for the economy in general and corporations, and the likelihood that although we might see some increase in delinquencies, it's probably going to be modest. Until we have, I think, more of a pullback in the labor market. But one other point I would make on the labor market, on the next chart, amid all this pessimism about the economy in certain areas, I find it interesting that if you compare what companies, this was a survey of CFOs that was conducted in the middle of September, what companies are saying about their own company's financial prospects versus the financial prospects of the economy, there's a huge gap, much bigger gap than we usually see. And companies are actually pretty optimistic about their own financial prospects. And I think that's what will drive their decisions on hiring, on investment. And that's what gives important support to the economy.
Sylvia and Gary, do you want to?
Yeah, I was going to add just a point on that. I think ultimately what drives corporate balance sheets are how the consumer is spending. 70% of the GDP in the US is made up of consumer spending. So the reality is consumers are still very healthy. We had a slide earlier that just talked about the delinquency rates for consumers across various credit products. And the reality is that, consumers' delinquencies are still low and certainly below pre-pandemic levels. They are inching up, and you can see that card balances in terms of delinquencies are increasing. On the bottom chart there, you see accounts 30 days past due in the auto sector. They're increasing through the end of September. But not all consumers are created equal. And so what we're starting to see is a little bit of a bifurcation. The high-end consumers doing well. But if you look at Gen Z and millennials, they're not performing as well. And that's a simple function of the fact that wage gains have not kept up with inflation. And so what consumers are doing is, if you don't have enough income, you're supplementing that with credit. And that's why we're seeing balances for Gen Zs and millennials on a year-over-year basis increasing as much as 25, 29% for that lower income, younger consumer. And so that's only sustainable for so long. And so this is definitely going to be a headwind going forward on credit quality. Credit quality is very good and certainly better than pre-pandemic levels, but you can see it on these charts inching towards, maybe an area of greater concern. I think you also add on to that the fact that there are going to be some changes happening during the pandemic. There were a lot of stimulus applied by the federal government. That stimulus has been removed. One key area you want to look at is forbearances. So student loan forbearances. 20% of Americans have student loans, 36 million. The end of those forbearances is happening at the end of this year. Most of those folks haven't paid back a loan in 2 years, and so that's going to add additional pressure in addition to inflation. And so we're watching that. Again, consumers super healthy now. You can see that in bank results, but there definitely are some headwinds like forbearances and the increased utilization of credit. And final one, obviously, is interest rates are rising. So if you have a consumer that has more credit, the debt service is higher too, right? Once interest rates go up on that variable debt, and that's going to be a continued headwind going forward.
It's nice to know that millennials are still getting blamed for everything.
Yeah. Oh, and we've added Gen Zers to it though too. Yeah. Why should millennials have all the fun?
All right, so staying on corporate credit for a minute, there's this big regulatory change, potential regulatory change, I should say, on the horizon. And Gary, I think you might have some views on this. The NAIC and their proposal to increase capital charges for insurance companies investing in CLO tranches, particularly in the mezzanine part of the capital structure. So, do you think that this change is likely to happen? Do you think it makes sense? And how do you think it might affect the CLO market? And I think we have a polling question on this one. Yeah. Okay. So Gary, do you want to address that
Yeah.
one?
So just to kind of take a step back, right? Like I've been in the industry for a long time, and I think a lot of you guys have been in the industry for a long time as well. This is probably like about 15 years ago when I felt the love of the industry is being surrounded by regulators from the NAIC, accountants, whatever the case it might be. That while the question is specific to the CLO markets, but the NAIC is not just focused on the CLO markets, right? They're talking about potential change in capital charges regime with CMBS, RMBS, and as well as ABS as well. So I think part of it is the fact that the NAIC has learned its lesson from 2007, 2008 that they were a little bit too late into the game to trying to regulate a asset class that is becoming a larger component of insurance asset allocations. So insurance companies tend to invest in their total assets about like anywhere from 10 to 20%, and some even higher to securitize asset up to 45%, 50% on a traditional insurance asset allocations. So securitize is a big component of the total book. And CLOs over the last couple of years has become a increasingly larger part of the overall insurance company allocation. And insurance company has become a bigger holder of CLOs, especially in the single A and triple B part of the capital stack. It makes up about more than 50% of the outstanding CLO bonds. So I do believe that I don't think insurance company will be forced sellers if the NAIC regulation were to be implemented as is. There's still very early on in the stage in terms of what the final outcome is going to be. But effectively, what they're trying to do is move CLOs to a model security, just like CMBS and RMBS. And if we looked at what happened in the post-crisis world in CMBS and RMBS, right, it's actually benefited the industry now that you're able to have better transparency in the regulation by the regulators. And also the fact that from a concentration perspective, again, a single A and triple B, the outcome for triple B and below are most likely to be increasing capital charges, while single A bond is still kind of in between in terms of like potential get a increase in RBC charges or potential an uplift from a capital relief perspective. So for that reason, I don't think insurance company will be a forced seller, at least in the earliest stage, until more clarities are being given. And further, even if the capital requirements increase dramatically for CLOs, like the way that we think about it is like look at what happens on the corporate bond space, right? Like back then, NAIC used to be NAIC 1 to NAIC 6 for corporate credits. Now that there's 20 categories within the NAIC 1 to 6 category, that there's more granularity from A minuses and above. And when the NAIC took that change into effect 2 years ago, the market was concerned that with this increasing granularity, that the insurance company would be actually investing more into high yield double B plus double B minus credits because you actually get a capital saving while investing less on A minus IG credit because there's an actual increase in NAIC charges. But what we saw in 2021 and 2022 is the complete opposite, that insurance company, for those who needed RBC capital relief, were actually selling high yield bonds. So despite the fact that you get an uplift from a capital saving perspective, high yield bond is still the most effective bond to sell to raise RBC capital from a dollar perspective. So I think there's a lot of uncertainties in the market on how this thing is going to unfold. I don't think insurance company would be forced seller into the space. Now, would that change their incremental demand going forward? I think that's likely. The way that we're trying to position it in our portfolio is that the required rates of return that we're looking to earn on single A and below securitized assets in general has to be higher to take into consideration for the potential change in NAIC RBC impact.
Right. Okay. Let's zoom out and talk about geopolitical risk factors for a minute. I mean, there's many things we could possibly talk about here. Ukraine, Russia, China, energy markets, fiscal policy. But Jonathan, I want to start with you. What do you think is the most important geopolitical risk factor for markets over the next 12 to 18 months?
Right. Well, I mean, you mentioned the issues in England, and obviously the UK and the blow up when the Truss administration attempted to put in a very generous tax cut package at the same time that they were being buffeted by high energy prices and trying to shield consumers from that. And of course, that exposed a very fundamental inconsistency between fiscal policy and monetary policy. Markets certainly picked up on that and certainly drove up the price of gilts. But one thing that's kind of underappreciated here is just the role of financial stability here and the role of this very difficult transition from going from quantitative easing to quantitative tightening. So we've had central banks that have basically been supporting the gilt market and of course the treasury market with their purchases. They're kind of out of the picture now. And what was exposed in the UK is basically pension funds that were making very immense bets on rates coming down. And were kind of caught in a very difficult position where they had to liquidate their gilt assets, and it actually added fuel to the fire. So it really exposes kind of this liquidity issues in the bond markets going forward that could be an issue more broadly, that we could be dealing with issues with liquidity in the bond market in the US. We certainly know that markets aren't perhaps as thick as they've been over the last couple of years. And this is going to be a potential issue as we go forward with the Fed actually bringing down its balance sheet. So I think it exposes kind of these limits on the ability of fiscal policy to act independently, but also kind of these very subtle financial stability issues that central banks will have to deal with in terms of market functioning.
Conrad, do you want to jump in there?
Yeah, I mean, obviously these geopolitical factors are adding a lot of uncertainty and making trying to get an idea of the outlook much more difficult. But I would agree that the financial stability side and those kind of risks, which are in part related to geopolitical issues, are very important. I think that for a while now, there's been this view that the Fed's or central banks' inflation fighting will come into conflict with the real economy. And I actually think that there's a far greater likelihood, and I think that what happened in the UK exposes this, that the inflation fighting comes into conflict with financial stability issues. And so now we have this very bizarre situation in the UK where the UK is buying bonds and raising rates and is expected to raise rates by 100 basis points at its next meeting. So that's I think that's the big uncertainty that macro policy faces as the Fed continues to raise the funds rate. And I do think the funds rate's going above 5%. I think that'll happen early next year. And the question is, in a financial system that is significantly more leveraged, and what we've learned is we don't know where that leverage is. What will that cause? And will we see blow-ups? And will the Fed have to reverse some part of its policy because of that versus any sort of concerns about the near-term economy?
I think one that I think not enough people are looking at is the risk around wealth inequality. If we just look at the last 2 years during the pandemic, we saw a lot of social unrest around Black Lives Matter, Stop API Hate. Women were out there protesting inequality in the job market. And those risks are going to increase as we go to an economy that's slowing down. And most developed markets have this issue. So most of you are either on the issuer side or on the investor side. If you're not thinking about the S in ESG, you're making a mistake. That's going to be a big risk. And that's why we're seeing a lot more issuers bring to market socially responsible credit portfolios. We're seeing on the buy side PMs really looking at ESG criteria and more on the S than the E. I think that's a big risk that's underestimated, and it's going to be exacerbated as we go into a slowing economy. And we saw it happen already during the pandemic. It's funny how we've all forgotten about all that, but it's still alive. It's real. And the reality, easy money meant it was exacerbated. The wealth inequality gap actually got bigger. And so we're going to be facing those. And I think it's the responsibility of every person in this room to be thinking about how they can use their business, not just for profit, but for good. And that's not going to go away.
Well, I think we have a polling question on ESG, actually. That's our final one. And that, I'm glad you brought that, because we are supposed to talk about ESG on this panel. And it's kind of topical because ESG's had a pretty rough year. Bit of a backlash, I guess you could call it. We were at a private equity conference in New York recently that got disrupted by climate protesters, and they were arguing that PE firms are using ESG to hide fossil fuel investments. But then on the other side of the spectrum, you've got Republican states pulling money from BlackRock, because arguing that they're using ESG to boycott the fossil fuel industry. So there's a lot of noise around ESG. But regardless of what you think about it and whether you think those particular risks should be kind of artificially put into that bucket and kind of have an industry created around them, those risks don't go away, to your point, Silvio. So just kind of rapid fire across the panel, how important a risk factor do you think environmental, social governance are like for global financial markets over the next 12 to 18 months? And are there any particular ones? I mean, Silvio, you mentioned social, but like
Yeah. Well, I think it's a risk and a return balance. I mean, I think if you look out over the next 2 to 3 years, what are going to be the best assets? The assets that are going to outperform. They're going to be socially responsible portfolios, right? That's why at VantageScore, we've really focused on this. We have a lot of new ABS issuers like Synchrony, One Main, Opportune that are coming to market, and they're using VantageScore only because it includes more people in their portfolios. And so that's going to outperform because, quite frankly, that segment of the market has been left out. I do think that is the biggest risk and slash also the biggest opportunity is the social, the S in the ESG.
So I would argue that they're equally important. Like to me, ESG risk is real credit risk. As a credit guy, like I think all of us here are used to evaluating the E and the S and also the G components for our asset classes, right? Like commercial real estate is a good example, right? Environment impact, it's a huge component from the way that we underwrite credit risk. The G components, governance, you already covered S, I'll skip S. And on the governance side, I think CIOs is very corporate governance. Manager style really matters. So for that reasons, like we at AB see ESG risk as real credit risk.
anyone else want to jump in there? Okay. We are technically out of time, but we might have time to squeeze in a couple of audience questions if anyone wants to ask anything. Anybody?
When is lunch?
No hands. All right, it's lunchtime. Thank you very much, everyone.
Yeah.